Palo Alto Networks PANW, they're in the S&P 500. Dish Networks, Dish, they're out. See you after the intro. All right, so on Friday, we had the announcement that Palo Alto Networks, ticker symbol PANW, is going to be added to the S&P 500, the most commonly well-known, most traded index there is in stock market investing, especially in the United States. After earnings on Friday, Palo Alto jumped a little over 7%. Here we see it. Recording this Monday a little after 11 o'clock in the morning. Shares are trading for $226, up 4.3%. So we're seeing that momentum remain with Palo Alto Networks here. We've got them trading at the very top of the 52-week range. Up here, very top was 228.50. Over the past year, up 31.5%. If you kick over to the year to date, up 64%. So pretty spectacular performance as of late. And you'll see the same thing on the 5-year and the 10-year charts. We've got a 5-year return of almost 234% and a 10-year return of, just 1,400%. No big deal there. Not a dividend payer. We see a price to earnings ratio on Palo Alto right now, just under 51. So very richly valued. You'll see why when we get to the growth, the previous growth, as well as the growth estimates moving forward. Surprised to see this 7% short interest on Palo Alto. I suspect that's due to the very lofty price of the shares, because certainly when you get into the metrics, the balance sheet, the business model, there's really nothing there that would lead you to short this company. Market cap, $66.5 billion. We see analysts across the board buy ratings, especially Wall Street analysts. We'll take a look at that in just a moment. At the factor grades here, the only thing that's not exceptional is valuation, as we just covered the lofty price to earnings ratio on this one. But growth, profitability, momentum, and recent revisions, all outstanding grades. Kicking down to revenue. Actually, let's take a look at Wall Street ratings here. We've got 25 buy ratings from Wall Street analysts, 25 strong buy ratings, 11 buy ratings, and 6 holds. So overwhelmingly positive. A couple of bull statements, no bear statements to speak of. Looking at revenues here, we've got annual revenues back in 2018 of $2.25 billion. Let's see, 4 years later in 22, we've got 5.5. So over the course of 4 years, we over doubled revenues. Pretty exceptional. Kicking forward to some 2023 estimates, we've got just under $7 billion, and 2024 estimates of almost $8.5 billion. So just looking at this beautiful revenue growth chart, it's been exceptional and doesn't appear to be slowing down anytime soon. For earnings estimates, again, in 2023, we're expecting EPS year-over-year growth of nearly 70%. This is where you see that nearly 51 price to earnings ratio. In 24, we're expecting a mid-teens grower, 25, a high teens grower. You see that with the revenue 3-year CAGR here of almost 26%, pretty spectacular. Profitability, when you look at a lot of these tech companies, the profit margins are unbelievable. You've got almost 71% gross profit margin. And that's why the balance sheets are typically so healthy on these companies. We've got about almost the exact same on the debt as well as cash on the balance sheet. Does not pay a dividend, and a very high percentage of institutional ownership, almost 86%. For comparison's sake, some of the peer group would be VMware, Fortinet, CrowdStrike Holdings, and ServiceNow. All of them, for the most part, hold similar buy or strong buy ratings. And just to review here, so we've got Palo Alto Networks joining the S&P 500. Dish Networks is out, ticker symbol Dish. So Palo Alto in, Dish is out. And if you are curious, I want to pull something up here. The requirements for joining the S&P 500. If you're not familiar, you've got 6 considerations, right? So you've got market cap, needs to be obviously a large market cap company. It's the S&P 500. It's the 500 largest companies traded by the Dow Jones index there. Financial viability, basically you got to have positive earnings. You don't have to. This is guidance, not the rule, right? There are always exceptions, but this is what kept Tesla out of the S&P 500 for as long as it did. Financial viability, basically last earnings quarter have to be positive, and then I think it looks for, the four most recent quarters should be positive earnings as well. Next up, we've got liquidity, the percentage of shares, basically your float that are publicly traded. You have to have a high trading volume, high share turnover by buyers and sellers. You got to be listed on the New York Stock Exchange, the NYSE, or the NASDAQ, the Qs, QQQ. And financial performance, positive record, historical record of financial performance, stability over time. They don't want this to be some company that's unstable, untrustworthy with their financial reporting. And lastly, the sixth factor for S&P 500 inclusion would be sector representation. Basically, the Dow Jones that manages the S&P 500, they want broad diversification across sectors, and the companies need to fit into a sector, the 11 sectors of the stock market. So those are some of the factors that are required and allow for S&P 500 inclusion. So frankly, I was a little surprised that Palo Alto Networks wasn't already in there. But again, it takes time, and you have to have some history on your side, some proven, sustained performance. That about does it for the update. Hope you enjoyed it. Take care. Let's make some money. Bye bye.